Assalamualaikum. This week we're going to be doing a new chapter that is analyzing investing activities. Analyzing investing activities involve evaluating assets of the company. Okay, so we already learned about the assets are the resources controlled by a company for the purpose of generating profit. Well, we already learned about the category of asset. There are current and non-current asset, and sometimes they are classified as the tangible and intangible assets. Okay, so the investing activities refer to a company's acquisition and maintenance of investment for the purpose of selling products or providing services and for the purpose of investing excess cash. So examples of investing activities include the acquisition or the purchase of the long-term investment or the building used in the company or the equipment used in the business, okay, and also include the sale of the long-term investment and so on. So the function of analyzing investing activities, therefore, is to determine how well the company utilizes its assets from the capital raised from the financing activities, okay, whether the company is issuing debt financing or the company is using equity financing, okay, in generating income for the company. Okay, now let's start with the current asset. Current assets are all assets that a company expects to convert to cash within 1 year. So they are commonly used to measure the liquidity of a company. So current asset would include cash, receivables, inventory, and investment. So this investment that is maturity less than 1 year, referring to the marketable securities. Okay, next is current asset operating cycle. So the operating cycle is the average period of time required by a business to make an initial outlay of cash, okay, from producing a good, sell the good, and receive cash from customers in exchange for the good. So that's why it's stated here the amount of time from commitment of cash purchase until the collection of cash resulting from sales of goods or services. All right. So this is the cash conversion cycle or cash operating cycle. So we start from cash and then the company purchase the goods or purchase of goods or services. Okay, so this one is like company purchasing their raw materials. Okay, until the company producing the inventory, or here is the finish. Okay, finish goods. All right, and then start to sell their inventory. So if the sales is done in credit, okay, so there must be a receivable here, okay, account receivable. Okay, the sales can also be done in cash, all right, and then until we collect back our receivable, okay, to get back our cash. So that is a cash operating cycle, the whole process from we purchase the materials until we produce our finished good, until we sell it, and then until we collect, all right, our receivables. All right, so this is a cash conversion cycle, CCC, sometimes called as a net operating cycle or cash cycle or cash to cash cycle time. Okay, so the cash conversion cycle measures how long it takes your business to convert cash into inventory, then into sales, and then finally back into cash again. So you calculate the cash conversion cycle by figuring out how long it takes you to sell the inventory, how long it takes you to collect your account receivable, and how soon you can pay your accounts payable. So the three components of the cash conversion cycle are receivable days, inventory days, and payable days. The cash conversion cycle can be expressed as a formula. CCC is equal to DIO, days of inventory outstanding, plus DSO, days sales outstanding, minus DPO, okay, days payable outstanding, where we can calculate the DSI by averaging inventory. We can calculate the DPO by averaging the accounts payable, and we can calculate the DSO by average accounts receivable. Okay, so a good cash conversion cycle is a short one. So if your CCC is low, Or negative number, that means your working capital is not tied up for long and your business has greater liquidity. Okay, so we can see that many online retailers nowadays have a low or even negative CCC because they drop ship instead of maintaining inventory. So they get paid right away when the customers buy products, and they do not have to pay for the inventory until the customers have already paid them. So if CCC is a positive number, you do not want it to be too high. A positive CCC reflects how many days your business working capital is tied up while you're waiting for your accounts receivable to be paid. Okay, you may have a high CCC if you sell products on credit and have customers who regularly or typically take 30, 60 or even 90 days to pay you. And there are several ways you can actually shorten your business CCC. Okay, example, you can make sure your account receivable process collection is efficient as possible. Okay, and then you can also shorten the CCC by asking for upfront payments or offering discount for early payment. Okay, and then finally, it's a good idea to stay on top of late payments by following up them immediately when the payment comes due. Alright, so this is the CCC example. So given the turnover ratios of turnover receivables 9.6, inventory turnover 4.3, and payable turnover is 11.6. So how do we calculate the CCC? We know that the CCC is equal to DSO plus DIO minus DPO. So we have to calculate the days outstanding first, okay, which is 365 days. We divide by the turnover ratios. Okay, so for the DSO 365, we divide by the turnover 9.6. So we get the days outstanding is 38. And then for the DIO 365 days, we divide by the turnover ratio 4.3. So it is 85 days outstanding. And then for the DPO 365 days, we divide by the turnover 11.6. So it is minus. Okay, the days outstanding is 32. So 38 plus 85, and then we minus with 32 days of payable. Okay, so the cash conversion cycle of a company is 91 days. So meaning to say here, the company takes about 91 days, okay, to get back the cash. Alright, next is current asset valuation. Okay, normally cash equivalents, and liquid investment in marketable securities such as an interest-bearing short-term treasury bills, okay, are the obvious inclusions in a current assets. So if the market value of the short-term asset falls, companies actually lose liquidity, and that's why cash and cash equivalents are usually required to be kept on hand, okay, as a compensating balance to support existing borrowing arrangements or as collateral for debt. Okay, next is receivables valuation. Analyzing a company's account receivable will help investors gain a better sense of a company's overall financial stability and liquidity. So receivables are reported at their realizable value, which is calculated by subtracting the entire amount of receivable from an allowance for the uncollectible accounts. So because of the receivable of all types are normally reported at their net realizable value, which is the amount that the company expects to receive in cash. So they minus the uncollectible account, okay, which is the uncollectible accounts are called as so this one is a bad debt. Okay, so normally business owners know that some customers who receive credit will never pay their account balances. So that's why the allowance for the uncollectible is calculated by management based on past experience, the customer fortunes, the economic condition, the industry expectation, and the collection practices. Okay, money in account receivable is money that's not in the bank and it can expose a company to a degree of risk. Okay, so the assessment of earnings quality is often affected by an analysis of receivable and their collectability. So the analysis must be alert to changes in the allowance, such as computed relative to asset receivable or industry and market condition. So basically there are two special analysis question about the collection risk and the authenticity of receivable. So for the collection risk, so the company have to review the allowance for the bad debt in the light of the industry condition, or the company can apply the special tools for analyzing the collectability, such as examining the customer concentration, because the risk increase when the receivable are concentrated in one or a few customer. Okay, and then about the authenticity of receivables, so the company can review the credit policy for changes, or review the return policy, or review any contingency on the receivables. Okay, next, analyzing prepaids. Okay, prepaid expenses are advance payment for services. Advance payment for services or goods not yet received that extend beyond the current accounting period. Example are advance payment for rent, insurance, utilities, and property taxes. So when managing a business, you have to pay for some asset in advance, okay, such as rent and insurance. Okay, so normally the non-current prepaids are commonly included with the current prepaid expenses for convenience purposes. So nevertheless, when their magnitude, the amount is significant or high, they should be reviewed. Okay, so any significant changes in the prepaid expenses should be evaluated. Okay, should be investigated or should be reviewed. Alright, next, inventories. So inventories are goods held for sale as part of company's normal business operation. So considered as an important asset of a company's and will affect the determination of income. So inventories initially record in the balance sheet, but once it is sold, it is transferred into the income statement as COGS, or cost of goods sold. So in general, when we speak about the inventory, we are referring to a company's good in 3 stages of production. Okay? Number 1, goods that are raw materials, and then number 2, goods that are in the production, and number 3, goods that are finished and ready for sale. So in other words, if you take the goods that the company has in the beginning and then add the materials that it purchased and then to make more goods, and then subtract the goods that the company sold, so that is a cost of goods sold. Alright, and then the result, what is remains, what is unsold, is called as your inventory. So these are the inventories costing methods. Okay, FIFO, LIFO, average cost. Okay, so the FIFO is the method assume that the first unit purchased are the first unit sold. Okay, first in, first out. Okay, first unit purchased, first unit sold dulu. Okay, and then the LIFO, under this method, the last unit purchased are the first to be sold. Last in but first out. Okay, and the next, average cost, in this method assume that the units are sold without regard to the order in which they are purchased. Okay, so the gross profit of a company can be affected by the company's choice of inventory costing method. Okay, let's have a look at the figure here. So this is a FIFO, which is the oldest cost, is the cost of goods sold. Alright. Okay, and then the recent costs are the ending inventory. And for the LIFO, recent cost is the cost of goods sold. Okay, the last in, the first out dia jual dulu. Okay, and then the oldest cost yang tak terjual yang sebelum ni dia beli, so that is the ending inventory. That's for LIFO. Okay, now let's take a look at the illustration on how to calculate the cost of goods sold and the gross profit of the company if the company applying different method of costing in inventory. Okay, so inventory on January 1st, year 2. Okay, let's say the company first purchase inventory on January 1st. So mula-mula dia beli 40 unit at $500. So it cost the company So this is a total cost of inventory 20,000. Okay, and then next the inventory purchase during the year 60. Okay, so we can assume this one is the last purchase. Okay, so last purchase 60 units. Okay, now harga dah naik jadi $600. Okay, so it cost the company 36,000 inventory. Alright, so altogether cost of goods available for sale is 100, which is 40, yeah, plus 60, so 100 units, and the total costs are 20 plus 36, 56,000. Alright, so the question is here. Note that 30 units are sold in year 2, okay, in this year, for 800 each for the total revenue of 24,000. So dia ada 100 units tapi the company only managed to sell about 30 units saja terjual. Okay, so that's why 30 we times with 800, so this is the selling price. Alright, so it will give the revenue or the sales for the company about 24,000. So this is the sales or revenue. So let's have a look at here. Okay, so if the company is using FIFO method, so the beginning inventory, the first yang dia beli adalah 20,000. Okay, plus net purchase of the last they purchase 36,000. So the cost of goods sold 15,000 plus 41,000. So mana dia dapat cost of goods sold 15,000. So the question said that the company sell 30 units. Okay, so bila FIFO ni dia akan jual yang dia beli stok mula-mula dulu. Dia akan first in, first out. Stok tu yang dia jual dulu. So dia akan ambil stok, dia akan ambil jual yang ni daripada yang ini. So daripada 40 ni dia akan jual 30. Okay, so kita akan minus 30 kat sini. Okay, kita akan minus 30 kat sini. So 30 yang dia jual. So 30, okay, you times with 500. So the cost of goods sold is 15,000. Okay. Yang ni 15,000. Datanya daripada mana? Okay, 30 units yang kita jual tu dia ambil daripada first in. Maknanya first stock yang dia beli dulu, which is 500. So that's why dapat 15,000 dekat sini. Okay. And then the ending inventory. So the ending inventory, we go back to the question. So kalau kat sini ada 40 tadi dia dah jual 30. So ada lagi remaining about 10. Betul? Okay, so 10 you times with 500, okay, 5,000, okay, and then plus, yang ni tak terjual lagi lah, yang ni 60 ni semua, belum, unsold lagi, okay, so you just plus with 36,000, okay, so yang ni tadi dapat daripada mana? Dapatnya daripada yang ni ada 40 tapi dia jual 30, so ada lagi 10 yang tak terjual, so 10 unsold. Okay, at the price of 500. Dia beli masa tu harga 500 lagi. So which cost 5,000. And then plus, yang ni lah. Yang second ni, 60 ni. Yang dia beli last tu, semua tak terjual lagi. Ada lagi 60. Yang ni dia beli pada harga berapa? 600. Okay. So 3,600. 36,000, sorry. 36,000. Okay, and then you plus with 5,000, so you akan dapat 41,000. So itu kalau dia pakai FIFO method, maksudnya first in, first out. Yang dia beli dulu, yang itu yang dia jual dulu. Okay, and then if the company is using LIFO method, okay, LIFO pula kita tengok. LIFO beginning 20, net purchase 36. Okay, cost of goods sold, maksudnya kalau LIFO last in, first out. Yang dia beli last tu dia jual dulu. Okay, so dia kata kat sini dia jual 30 unit. So dia akan jual yang ini dulu. Okay, padam yang ini dulu. Sekejap. Tak nak bagi confuse. Alright. So dia akan jual yang ini dulu. Okay, so dia jual 30 unit. So 60, 30. 30 times 600 lah. Okay. So 18,000 cost of goods sold. Ni. Cost of goods sold 18,000 dapat daripada mana? Dia akan dijual yang dia beli last. So which is 30 unit yang dia terjual tu dia ambil daripada stok last yang dia beli pada harga 600. So that's why dapat kat situ 18,000. So ending inventory. So kita go back lah tengok kat sini. So kalau dia dah jual yang ni 30, ada lagi remaining 30 kan? So 30 lagi remaining tu 18,000. Okay, so 18,000 plus dengan yang ni. Yang ni memang dia tak jual langsung lagi sebab dia jual yang ni dulu. Okay. So yang ni masih ada lagi 40 at RM500. So which is 20,000. Okay. So yang ni tadi dapatnya daripada 30 lebihan daripada last. Okay. We times with 600. okay, which is 18,000. Okay, and then plus dengan yang mula-mula jual tu, mula-mula beli tu first in, dia tak jual langsung lagi, masih lagi ada 40. Okay, so 40 dengan harga berapa? 500 yang dia beli. Okay, so that is 20,000. Okay, so kalau ditambah dua ni dapatlah 38,000. Yang ni dapatnya daripada yang itulah cara dia kira. Okay, and then next, if the company is using average cost method, okay, macam mana dia kira cost of goods sold kalau dia pakai average cost method? Okay, so we go back to the question. Kalau dia pakai average, dia tengok pada total yang ni. Dia tengok pada yang ni. Okay, so which is, dia ambil direct je. 56,000 divided by 100. Okay, kita nak dapatkan harga cost untuk satu tu, maknanya dia beli pada harga 560. So, if kata 30 unit saja terjual, so 30 times 560 lah. So that's why dapat kat situ 16,800. Okay, so yang ini datanya daripada 30 times 560. Okay, so dapatlah kat situ 16,800. Macam mana dapat 516 tadi, dia bahagikan. Total 56,000 ni dibagi dengan 100 unit. So harga untuk satu unit dia beli tu diandaikan dengan harga 560. Okay, so kalau dia jual 30, ada lagi remaining 70 lah kan. Ada lagi remaining 70 yang unsold. So 70 darab dengan 560 jugalah. So that's why dapat 39,200 kat situ. So to calculate the gross profit of the company now, so if using FIFO, sales 24,000 minus cost of goods sold ni 15,000 kat sini, so the company will get the gross profit about 9,000. But if the company is using LIFO, 24,000 sales minus 18,000 cost of goods sold kat sini sama, so the company will get the gross profit about 6,000. And if the company is using the average cost method, so 24,000 sales minus with the cost of goods of 16,800, so it will give the company gross profit about 7,200. Okay, last one is long-lived asset. Long-lived assets are resources or claims to resources are used to generate revenues or reduce costs in the long run. So the examples of the long-lived assets are tangible fixed assets such as property, plant and equipment, intangible assets such as patents, trademarks, copyrights and goodwill, and also the deferred charges such as R&D expenditures and natural resources. Okay, next is accounting for long-term assets or fixed asset valuations. Okay, number one, we look at the capitalization. Okay, capitalization is a process of deferring a cost that is incurred in the current period and whose benefits are expected to extend to one or more future periods. So, an item is capitalized when we record it as an asset rather than and expenses on our income statement. So we record it on our balance sheet. Okay, so let's say if we buy a piece of equipment or piece of machine, okay, that costs 1,000 ringgit. Okay, so rather than report 1,000 as an expenses in our income statement, okay, we record it in the on the balance sheet as an asset worth 1,000 ringgit. So as time goes on, okay, we amortize or the asset depreciate over its useful life. Okay, so taking a depreciation expenses each year and reducing the balance sheet value of the asset by the amount of the expense. So this process is called the capitalization. Essentially, okay, allows your company to spread the cost of the assets over its useful life and avoid drastic impacts to the income statement. Okay, in the period the asset was purchased. Okay, when we say fixed asset, we are talking about an item that is used in the company in the operation of business. So fixed assets are usually an expensive things in nature and do not include inventory for resale or repair or spare parts inventory. So typically an item is not considered to be an asset to be capitalized unless it has a useful life for at least 1 year. Okay, so the capitalizing asset has many benefits because of long-term assets are costly, expensing the cost over future period reduce significant fluctuations in income, especially for the small firm. So many lenders require companies to maintain a specific debt to equity ratio. So if a large long-term assets were expensed immediately, it could distract or compromise the required ratio for the existing loans, or could prevent this firm from receiving a new loans because the higher debt to equity ratio. So also the capitalizing expenses increase a company's assets balance without affecting its liability balance. So as a result, many financial ratio will appear favorable because we record it as our asset, right? Okay, so despite this benefit, it should not be the motivation for capitalizing an expense. Alright, number 2 is allocation. Allocation is a process of periodically expensing a deferred cost, cost of an asset to one or more future expected benefit periods determined by benefit period, salvage value and allocation method. So here is like you are determining what are the methods of depreciation used by the company for the tangible or fixed assets. Alright, what are the useful life, what is going to be the salvage value after its useful life. Alright, so that are the process of allocation, when you are valuing your fixed assets. And the other terminology used for the intangible asset, we don't call it as depreciation, we call it as amortization. And for the natural resources, like telaga minyak ke apa ke, we don't call it as depreciation or amortization, we call it as a depletion, right? For the national resources. Last one is impairment. Impairment is this process of writing down asset value when its value in use fall below its carrying value ataupun below than the book value. Or in other words, an impaired asset is an asset that has a market value less than the value listed on the company's balance sheet. Alright, so when an asset is deemed to be impaired, so it will need to be written down on the company's balance sheet to its current market value. So kita kena record the current market value of the asset. So assets should be tested for impairment on a regular basis to prevent overstatement on the balance sheet. And then assets that are most likely to become impaired include account receivable, as well as the long-term assets such as the intangible and also the fixed assets. Alright. When an impaired asset's value is written down on the balance sheet, there is also a loss recorded on the income statement. So I think that's all for this video. Thank you.